Good afternoon. Welcome to Green Bicep. Today we're going to cover consumer credit. This is the calm before the storm. We know the advanced decline line is weakening. The yield curve is inverted. We got all kinds of fun stuff going on. The Fed's going to raise rates a few more times, hold steady the rest of the year, likely raise again at the end of the year as China inflation pushes through. And then 2024 is going to be a lot of, well, it won't be fun. It'll be quite the opposite. Be ready? So review, we're going to go through HELOCs. We're going to cover revolving credit use. We're going to cover credit standards. We're going to get into home equity loans. We're going to get into credit use, excluding credit cards. We're going to utilization, you name it. We're going to cover it all today. So first things first, home equity lines. This line up, whoosh, that means more people are using home equity line of credits than prior. The trend is up. So that means their income is less than their expenses. They're spending more than they make. And you can see this happens during Christmas. You get a spike, you get another spike in Christmas, and then it comes back down. The fact is, since early 2022, that folks have been just spending more than they make, and they have probably because of inflation. Here we're looking at revolving credit. So this is not paid off on a monthly basis. You can see in 85, the slope was pretty, not too steep. 95, it got steeper. 2005, even steeper. And now we're at 2022, steeper. So the pace of credit use is going up faster before each bear market. Not a good sign. 19% is what they're charging now. Not a good sign. Here we're looking at credit standards. They are getting tighter. What does that mean? It means if you have a credit card, they could cut your available overnight. Whoosh, it could go from 20,000 to 10, and you're like, oh, I thought I had 20,000 on my card available. Now I only have 10. Your minimum payment could go up. You apply for credit, they could deny you, even if your credit score hasn't changed. Welcome to reality of the credit cycle. So since Q3 of 2021, credit standards are getting tighter. Be prepared. Don't get surprised. That's why you want to have cash, and it doesn't hurt to use some of your credit now and build up cash if you don't have cash. You got to find a way to get cash. Now here we're looking at demand for loans excluding autos and credit cards. Demand's down. So that's a function of either A, people not wanting credit because of the consumer sentiment. They're not very optimistic. Or B, they can't get credit. So it's not a good sign, though. Before a bear market, before 2020, it's interesting. It should have other bear markets shaded, but for whatever reason, it's because this is a small. All right, next, credit utilization. So this is looking at credit used excluding real estate. We're at 25%. That's not bad. That means there's still a lot of credit available. But as we saw earlier, the amount of credit being used, the revolving right here, it's up 16.9% annualized year over year. Right here, whoosh, straight up. So we got some really there's issues within the plumbing of the system. That's the people. They're feeling stretched. Here, sentiment's improved for Michigan. Sentiment's improved for the home builders a little bit. And sentiment is actually improved for ISM, but I pulled out. This is just new orders, so it's still going down. But regardless of the other two, it's still pretty crappy. It doesn't mean really much of anything. I just want to show you like there's a little positive feel going on. That has to do with, there's a lot of factors, but why the consumer feels a little bit more optimistic, which is a beautiful thing. What we really need is for food prices to drop off, then you'll see shoot right up ultimately. So the buying list, I'll flip through. The first section is, this line is cash. You want to have a lot of cash before a bear market like now. Well, we're in a bear market in my opinion. Gold, silver, Bitcoin, if they do stimmy checks, you want to own these babies. Next decade, be ready. China is opening, so this is a play on that region. I think this shipper's the best asymmetric bet. If you want to preserve more capital, sit in cash or investment grade bonds. If you want more exposure, like a little bit more alpha, I would definitely go with energy, but probably outperforming that will be the metals and mining. Event driven. Bitcoin miners are rocking and rolling right now. They're just gonna, yeah, they'll go up many times. Paramount, I don't have an update there on what Buffett's been doing, but it's fun to watch, and I think it's a good event driven play. And then South America, etc. That's really a play on the U.S. dollar getting weaker, which is the trend now, and it will be probably for a few years. And then healthcare, I'm going to provide an updated stock list probably of bull market stocks, so preparing for the next wave. And I have Amgen and Pfizer will not be on that list. I just have them here because they have great fundamentals. I think I'm just going to delete them. I just like having the reminder. If I have one company, I'm not going to share the name quite yet because I want to do due diligence, but it's in a high growth industry. Revenue is up 100%. Their price of book is less than 1. They don't have tons of debt, so I'm trying to figure out what's wrong with the company. So that's it today. Try to keep it short and sweet. Big picture, what's happening is the consumer is getting squeezed out. The Fed is going to raise rates a little bit more, and they're going to find that the consumer is not going to stop buying goods because they have too much credit available. Second half of the year, that wage inflation in service is going to likely continue unless the Fed has a good campaign, psychological warfare type campaign to make everybody believe that prices have come down. And that would be call up Kroger, call up Publix, call up those stores and have them drop prices, and that would immediately change the outlook and probably save trillions of dollars. But that's where we stand today. The consumer is weak. They have a long runway. This could go on for a long time. So just be prepared to weather. This is going to be a long storm. Just chill out, relax, enjoy the ride, and I'll try to provide guidance. Thumbs up if you like it. Subscribe. Tell your buddies. Thank you.